Welcome to the show, where you'll learn how to invest in mortgage notes, the savvy real estate investor's secret weapon to create cash flow without tenants and property acquisitions for pennies on the dollar. My name is Robert Haitha, founder of Fixed Notes, and my mission is to make note investing ethical, profitable, and accessible for you. In every episode, we're democratizing the industry to put these powerful Wall Street assets into the hands of Main Street investors like you. So without further ado, let's get into the show, where you're in good hands with my AI clone. Let's go. In this episode, I want to break down the key difference between performing and non-performing mortgage notes, the two major categories of note investments. A performing note is pretty straightforward. The borrower is making their monthly payments on time. You're essentially buying a cash flowing asset. You collect interest income each month, and the return is relatively predictable. The downside, you're paying a premium for that stability. You might spend $80,000 to buy a note that pays $700 a month, which nets you a 10% or 11% return. Still solid, especially when it's passive. Now, non-performing notes, on the other hand, are where I spend most of my time. These are loans where the borrower has stopped making payments. It could be a few months delinquent, or it could be years. Because of the risk and uncertainty, you can buy these notes at steep discounts, sometimes 30, 40, even 50 cents on the dollar, depending on the situation. But here's the nuance that most beginners miss. Non-performing doesn't mean worthless. In fact, the note still has value, sometimes significant value, because it's secured by real estate. That underlying collateral is key. Even if the borrower isn't paying, the property still exists and the lender still has legal rights. And as a note investor, you can step into that position and explore multiple resolution paths: loan modification, discounted payoff, deed in lieu, or foreclosure. Each one has its own timeline, cost, and potential return. What matters most is your ability to navigate that process or work with a team that can. When I buy a non-performing note, I'm not expecting to just start collecting payments. I'm stepping into a situation where something's broken, and that means there's opportunity to add value by solving problems. Maybe the borrower lost their job but is back on their feet and just needs a modification. Or maybe they've walked away and we can take the property back and resell it. I often say, non-performing notes are the fix and flip of the note world, while performing notes are more like a rental property. Both have their place. Performing notes are for passive income. Non-performing notes are for active investors looking to generate big upside by helping borrowers and repositioning the debt. And here's the beauty. When you buy a non-performing loan and get the borrower back on track with a payment plan or a loan mod, that note can become performing again. And now that it's cash flowing, it's worth a lot more, so you can either keep it or sell it for a profit. That's really where the magic happens. In the next episode, we follow the paper trail, literally, is get ready to meet the collateral and uncover the full life cycle of a note, from origination to resolution. Thanks for sticking around to the end, and thank you to my trusty Robot and the Fixed Notes team for putting together another episode. If you want to learn more and hang out with the real, not AI version of me, join our free school community at school.com/fixnotes. That's SKOOL.com/FIXNOTES. In the meantime, we'll see you in the next episode.